For the first time in a long time, we have no audit and no program management committee meeting this morning. So thanks to Todd and Rich for that. And because of that, Trustee Evans, we get to start with the Finance Committee meeting.
Okay, we will call to order the 323rd meeting of the Finance Committee. Can I get a roll call, please?
Yes, the record will reflect that all trustees are present, with Trustees Nicholson and Watson online.
Can I get a motion to approve the minutes of the December 30th meeting?
So moved.
Thank you. Next item is a quarterly pension update.
All right, we've got Deanna Jones in from NEPC. She is here to walk through the quarterly and year-end, I guess, update.
Yeah. So good morning, everyone. I'll mention it's an aggressive thing to talk about markets at 7:30 in the morning, so I'm going to try to make this interactive for you all and time efficient. So I'm going to do two things. I'm going to talk about the market as it ended in 2024 or 2025. Since this is our first time talking kind of year end, we also publish and we'll walk through the things that we think will drive the market for 2026. And then we'll talk about the MSD portfolio and the returns that you ended for the year. So if we could go to page 4, kind of top level, these are the things that were kind of key drivers or key thoughts around the markets for 2025. The first thing and most significantly is the interaction of AI in the markets and how that impacted returns. So all last year, and I'm sure for the years to come, you heard about AI through the lens of the Mag 7. So think about Google, NVIDIA, those large tech names that were really driving the market returns. And the reason why they were driving those market returns is because as of this point, they're representing right around 40% of the S&P 500 index. So the S&P 500 is a large cap index for diversified investors. For you, like MSD, that large cap index represents kind of an anchor position in your equity portfolio. So it's intended to be kind of downside protection, capital generation for your portfolio. So as you can imagine, if 40% of that index that you have exposure to are these Mag 7 names, however those Mag 7 names perform will have a pronounced effect on your portfolio. And you saw that trickle through the market for 2025. The next bullet is around the labor markets. So labor markets ended relatively soft for the year, but there are pieces of the labor markets that we have some concern about. So the first piece is the impact of decreased immigration on kind of lower income parts of the labor market. So think about the producers of things, particularly as you look at it through the lens of increased demand for AI, who are producing these things. The other piece of it is tariff-related things. Once again, think about what's driving the market now. If you can't import very cheaply precious materials to produce chips and things of that are driving kind of this AI growth engine, where does that leave the labor markets? Where does that leave the economy? The next thing were risk assets. So when we think about risk assets, what we're really thinking about is the way investors invest when they think the market is doing well. So in times of market distress, so think about when tariffs were announced, dollars flocked into things like core fixed income, which is essentially a basket of treasuries or government-related and very high-quality fixed income securities. When markets feel very frothy and there's a lot of growth, that's where you see things like equities outperform. And despite some of the things around tariffs, weakening labor markets, decreasing interest rates, you still saw risk assets do really well. Now, a big part of that story, to my earlier point, is around AI, but you still saw risk assets perform really well. And in a moment, we're going to see how MSD's portfolio benefited from that risk-on environment. The second to last bullet is around the non-U.S. equity market. So when I came in and talked to you all at our very first meeting, I talked about how the strength of the dollar We're encouraging dollars to come out of international markets and into our domestic markets. As you see that trade-off happening, so interest rates are lowering, some of those international dollars are leaving our markets and going back into the international markets, which is really having some upward performance for non-U.S. assets. In a minute, we'll show you how that also benefited you. The last piece of the story, and this is something that we added when we were retained as your consultant, was it's a favorable environment for real assets. So when you think about real assets, of course, it's precious materials, minerals like gold and silver, but we're also talking about things like liquid infrastructure, specifically for MSD. And within the liquid infrastructure bucket, because those are assets that have calls on capital predetermined early, and it has a longer duration, a longer tenure of their duration, you see those benefits, particularly in markets where interest rates are going down. So if we go to page 5, this is a bar chart of how the markets ended for calendar year 2025. As I've mentioned before, NEPC, we're very fond of blue, so apologies for all the blue. The dark blue represents equity markets, so those are your stocks, how they performed. And if you look, the first chart is global equity markets, so that is the MSCI, represented by the MSCI ACWI Index. That's a global index, so it includes domestic equity, developed international, and emerging. That index is heavily weighted to U.S. equities, and I've already mentioned the MAG 7 represents a large amount of the returns that you saw within U.S. equity markets. So that index was really buoyed by strong domestic equity markets. If we go all the way over to the darker blue charts at the end, the MSCI EAFE, that's developed international markets. So think about the UK's stock market. Those saw weaker returns in the beginning of the year, but as our interest rates came down, you start to see investors rebalancing or going back into those international markets, and that really helped them outperform pretty significantly relative to the U.S. markets. The kind of, I guess, medium blue bars right in the middle represents the fixed income markets, so the credit markets, the publicly traded credit markets. A couple of outliers on here. So the first bar that you see, the U.S. Ag Bond Index, that's that basket of core fixed income, so government securities, high yield credit, quasi-governmental or agencies within that bucket, really secure parts of the market. So within the MSD portfolio, that serves as your liquidity pool for us. If there is a time of market distress and Tim needs to liquidate assets, that's the first source of capital we will pull from. Positive performance on an absolute basis, significantly underperforming the equity markets, and a lot of that has to do with investors during the course of the year having a strong risk appetite. And then the last bucket that we'll look at, all the way over to the end, you see the only asset that underperformed for the year was the U.S. dollar. And that's on the back of kind of weakening or lowering interest rates and a slight weakening in the economy. So maybe in the interest of time, I'll pause and see if there are any questions. And if not, we can go to page 8 and we can talk a little bit about our themes for the year. So we have 4 themes for the year. Every year on an annual basis, our asset allocation team, and that's the team within NEPC who's responsible for developing our asset assumptions and also helping us narrate that to clients, develops themes for the year. So it's important to note that these themes we think will be present and drivers of returns for 2026. But it's not kind of even split between the driver of return, right? So there might be points in the market or points in the year where AI is really the driver of returns, and it can be driver of return on a positive side or a negative side. And there might be times where AI is kind of muted, but the U.S. economy is more prominent in driving returns. There are four kind of broad themes we're thinking about. The first one, of course, is AI, and we're looking at it through two lenses, not only the driver of returns in the capital market, but also what it could potentially do within the labor market. So if AI is working as some firms intend for it to work, it will replace workers, and those workers then need to be retrained to do something different in order to keep our labor market strong. So we are assessing the length of that transition and if that transition will really happen. On the other side of things, we're thinking about the actual CapEx spending has increased for AI. So similar to NEPC, we've invested in Copilot. A lot of firms are integrating CapEx spending into their balance sheets. What we're waiting to understand and fully digest is how efficient that makes a worker, right? So as I was preparing for this meeting, I dropped my deck into Copilot and said, I'm talking to this dynamic of board members, what are things that would be important to them? That makes me efficient, but it doesn't replace me, right? So we're assessing where AI will really fall and how it will impact the labor market. The second, next bullet to that is look at the U.S. economy. So we have a lot of legislation. The big, beautiful bill has passed. We're assessing the impact of that and what it will do to the capital market. There are some stimulus things in that bill, but there are some things that will be detractors from returns in that bill too, specifically around health care and what it would do to rural populations regarding health care. So we're assessing how that will impact the market, but we think that will be a big driver, positive and negative, for 2026. The green box is don't fear the U.S. dollar. So the U.S. dollar did weaken during the course of last year. It's important to note that the U.S. dollar is an asset, right? Assets are cyclical. Sometimes they outperform, sometimes they underperform. And we do think, generally speaking, that inflation was too high to be sustainable. At some point, inflation remaining high was going to create some fractures in the economy that could be more painful than they should be. So lowering interest rates was the only natural path. And with that, we expected that the U.S. dollar would go down. For 2026, the Fed is already issuing kind of dovish sentiments to the marketplace, so we expect more rate cuts. But that doesn't mean that the U.S. dollar is not strong. It just means that it's kind of right cycling itself. And we already kind of talked a little bit about the labor markets, so I won't go into that. Our comments around the impact of immigration and what that will do to labor markets. We also are looking at how wages are not increasing at the rate that they were during the post-COVID situation. So think about when you would drive around. I was living in St. Louis at the time, and I would drive around and see like McDonald's signs where they were hiring for $15, $16 an hour to work at McDonald's. You're not seeing that as much, and that's telling us that that wages, the amount of wages being demanded is kind of slower. You're also seeing less job turnover. So there's some softening in the labor market that we're keeping our eye on. So I'll pause and see if there are any questions on that, and if not, we can jump into the MSD portfolio on page 12. So this is your asset allocation as of the end of the year. A couple of things to note: this is a snapshot in time, and this is also just because of when Tim needs to liquidate assets to pay pension obligations. That snapshot in time tends to mean that your cash is high because we're liquidating in order to pay those benefits. So that $2.5 million went to Tim to pay those obligations. You're roughly in range, a little bit lower on the SMID cap side. We've right-sized that already. Another note is that you all, prior to NEPC being your consultant, had exposure to the UBS Trumbull Real Estate Fund, so core open-ended real estate fund. That fund has since wind down and they're returning capital to you. So we started to see some of that capital come back tail end of 2025, top of 2026. If we go to the next page, this is your performance. This is just because of the timing of your meeting. This is a little bit of a preliminary snapshot. Once we get the final one, we'll send it over to Tim. But preliminarily for the first 3 months or the last 3 months of the year, so your Q4 number, positive performance of 2.4%. You outperform your policy benchmark. So that policy benchmark, as a reminder, is what your experience would be if you were perfectly passively invested in those asset allocation targets you approved at the top of January. We know you were generally in line with your target, but there were some over underweights within that portfolio. So you benefited from those over underweights right around 40 basis points. Your allocation index helps us understand those active pieces of your portfolio, so managers that are retained by MSD to actively outperform their benchmark, how they help to hurt the portfolio. Some slight underperformance there. A lot of that has to do with the value weight that we have in the portfolio for your downside protection. So looking at your public equity portfolio, so as a reminder, that public equity, that stock portion of your portfolio is intended to be capital appreciation, the idea of I invest $1, but I get $2 back. That was a big driver of performance for the quarter, positive 3.3% for the 1 year period. And just that 1 year period captured some transition. So it was times you weren't kind of invested in this portfolio as we transitioned from the legacy portfolio to the NEPC portfolio. But that portfolio still had positive returns for you for the 1 year period, positive 19.7%, so almost 20% up from the dollars we initially invested in for the year. If we go to the next page, your international equity portfolio returned for the 3-month period 5.4%, so positive for the quarter, positive 5.4%. For the year, positive 29.5%. So you were the beneficiary of some of that weakening dollar and those assets being redeployed into international markets. Looking at your fixed income portfolio, once again, the idea of your fixed income portfolio, particularly that high quality fixed income portfolio, is really to be a liquidity source for us. That portion of the portfolio, this is kind of in the middle of the line, the total fixed income portfolio for the year, positive 4.3%. High quality added 80 basis points. Return seeking fixed income was a little bit of a draw on the portfolio for the quarter, but positive 7% for the year. So strong performance from your fixed income portfolio, even though it's not as strong as the equity markets. And then if we go to the last page, the last piece of your portfolio is your multi-asset portfolio. So that's intended to be a diversifier from fixed income and from equities, and also provide some inflation hedge for you. For the 1 year period, that portfolio returned 3.1%, positive 3.1%, and for the 1 year period, returned positive 16.6%. A lot of that outperformance was due to the strong performance from your liquid real asset manager, Metis. So what Metis will invest in is liquid infrastructure, liquid real estate, and then other commodity-driven things like gold and silver and precious minerals. And those were pieces of the market that just performed really well for the year. So they brought a lot of return to the portfolio from that. So I said a whole bunch in 20 minutes. I'll pause and see what questions anyone has.
Quickly, how often are you resetting the overall allocation?
So we will come in at our next meeting, backing up. So we look at your asset allocation policy that you adopt in your IPS on an annual basis. Typical expectation is that we won't do any major changes to asset allocation policy, maybe every 2 to 3 years, unless something about you changes. So if you decided to open the plan back up, that would trigger asset allocation policy. If the market, something just went really wonky in the market, that would trigger asset allocation policy. On the fringes, we recommend changes, so we might say add a percentage point to multi-asset, because we think in 2 years that'll be a driver of performance and we want to take some risk off. We do full-blown asset allocation studies. That's where we get your actuarial information. We run a liability study. We do that every 3 years, unless something changes. We rebalance. We do what we call strategic rebalancing on a quarterly basis. And that doesn't always mean we do major things, and we always play within those bands that you've adopted. So an example of that is like letting your internet or your domestic equity market be a little bit higher on the target size, but we kind of have your fixed income portfolio a little lower on the target size. So those are strategic things we do throughout the quarter. And the idea of that is to benefit from short-term market dislocations.
So you think, you guys have been here a year now, right? Mm-hmm. And you think the current sort of pace of interaction and moving things within the portfolio makes sense?
Yeah, we do. I'm hesitant to give you definites just because we're running those analysis now. We might do a percentage point a little bit more on return-seeking fixed income, just specifically within like the high yield or the absolute return pieces of fixed income. You're getting better downside protection than equity markets, but it's a cheaper part. It's a cheaper investment for you, so we're fee conscious. But the other piece of it is we want to build in some stronger downside protection in the event there is a more kind of noise that drives the market, right? So last year was a lot of volatility if you look at the VIX. And so with all of our clients, we're just thinking about how we build in better downside protection for clients who have to pay benefits on a monthly basis. So it's a little bit of a different recommendation for like our endowment clients who could essentially cut the spigot off if they needed to. Your function is to pay pension benefits, so we want to make sure you have strong downside protection in order to do that without selling assets in an extremely down market.
Would you recommend any changes sort of structurally to the way we interact with you?
No, but I would say we do for a lot of clients education. So if ever that is an interest, we do like a fiduciary training. We bring our thought leaders in to talk about the market. So if ever that's an interest, we'd be happy to set that up.
Okay, thank you.
No problem.
I
Go ahead. Sorry.
Just a very general question, back to something you had talked about earlier, the significant impact of AI on the market. What is your sort of insights into, is it overvalued? Has there been too much investment, too much hype, and the return on that is going to be kind of slower to see?
Pieces of it. So one of the things that we think about is actual earnings of AI. And when you look at kind of the balance sheet, a lot of those companies don't have actual earnings. The other piece of it is driving the market. So specifically, you see this within small cap, where if you had tech anything in your name, you had these high performing. But if you look at the small cap index, it's something like 30 or 40% of those companies are like negative earnings, right? So when you think about a risk you're absorbing when you invest in the stock market, even within growth, you want to see some material earnings, and it's a little bit concerning that I could have tech in my name and have no earnings and still have positive stock performance for a year. So I think there are pieces of the market. And we don't think AI is going away. We do think that it may not take the shape that everybody thinks it's going to take. So the people who come out and are like, oh, we're going to have self-driving cars and everybody's going to be in a self-driving car, we think that's an extreme case. But we do think that it does create, yeah, I know, for somebody who's not a classically trained driver, I think I might welcome a self-driving car. We think there are implications on, particularly when you think about like manufacturing and bringing in AI to make manufacturing more efficient, that replaces a worker, but where does that worker go, right? Like they have to be retrained. So what is that process going to look like? So we liken it to kind of when the automobile replaced the horse and buggy, but the tenor of that is what we're unsure of. Yeah. And you could be in a situation where NVIDIA in 2020, the stock was trading at $5, and look how different it is. But you also could be in a situation, and if you remember, during the first quarter, NVIDIA stock tanked, and it's since rebounded, but it tanked because DeepSeek announced that they could do what NVIDIA does at a cheaper rate, and it just really dropped the price, right? So whenever you're investing in these things, it's some risk, but it's more risk when it's kind of, they're figuring themselves out as they go along.
And then it's one thing to be aware of those risks and another to get the, timing
Yeah.
right, which is why we like those index funds and broadly diversified. But
Yeah.
as we talked about, there's a
To hedge
handful of
against
companies
the big-
driving it.
Yeah.
Driving a lot of the
all.
market. And that's also why we built in that value position within your portfolio, because in times of market distress, value does really well, because investors who are concerned about the market will move their money from kind of the growthier things and go to a value index because it's more secure, more downside protection. And so as we are building your portfolio, we're thinking about the mosaic of it. So we understand how much you have to liquidate on a monthly basis, what your comfortability around volatility is, and we're building all those pieces in to the portfolio.
Great, thank you.
And I won't go over this, I'll just hit on one thing. So page 18, as your discretionary consultant, one of the things we came in and talked to you about when we first were retained was that because we're such a large consulting firm, we have the ability to negotiate preferred terms for our clients. So as a benefit to you, as an NEPC client, we've been able to save you right around $365,000 in manager fees. So some of that is because we have passive investments that we negotiate preferred fees with, so that lowers your fees. But also on the active side, so a firm like Metis, who returned 25% for you for the year, we negotiated a preferred rate for them. So we just want to give you that snapshot. The operational piece is how many managers we have retained on your behalf or terminated on your behalf. The cash raises are when we raise money for pension obligations. And then the legal reviews are us looking through legal contracts or our attorneys looking through legal contracts and making sure that they are secure and you're protected in those contracts. Fiduciary oversight is our OCIO team. So if you remember, I brought my colleague Varun here talking to the managers. So on your behalf, we've talked to 60 managers, and some of those managers went into the portfolio. Sometimes it was talking to the same manager multiple times over the year. But this is just kind of a snapshot of the things we've done from an operational standpoint for MSD in the slightly less than a year time we've been your consultant. Okay. I'm a little bit over time, so I'll pause. Are there any other questions? Okay. If not, thank you all. I hope you have a good rest of your meeting.
Thank you, Deanna. And as I've mentioned before, this is the highest asset total we've ever had in the plan, so that's exciting. When we get to the middle of the year, the actuary will do their work. This year will replace 2022 in their 3-year smoothing. 2022 is the bad year where everything was down. So we'll see a decent increase in funding. That's what you should expect to see in the actuarial evaluation. It'll come out probably in May. So good 2025, and hopefully it continues, because we'll be able, what I hope is we'll be able to eventually take, adjust risk as we get better funded. From a market standpoint, we're probably over 90% funded for the first time in a long time, like 93, 94. Actuarial, it'll be high 80s still, because that's smooth and kind of lags where the market funded is headed. But anyway, good performance. So thanks for sitting through that. And now Marion has a couple of things to present.
Thank you. I'm not sure that I have as good of a news as you heard previously, but I will try to make this interesting for you. So I'm going to present, first of all, the Adjustment Review Committee report for the quarter of October through December of 2025, as required by our wastewater ordinance. So we had during the quarter a total of 82 transactions, which resulted in credits issued to accounts of approximately $1.3 million. I will cover the first section of the report, which presents the adjustments. There were a total of 70 adjustments, which totaled approximately $1 million in credits. The bulk of those adjustments were water agency adjustments. There were 23 adjustments, which totaled $879,000 approximately. Now, 2 of those adjustments totaled $465,000. There was a large adjustment that City Water made to an Ameren account. There were 2 reads that were incorrect, which covered about a 4 or 5 month time period. So we got that information and had to make adjustments as well. There was also another adjustment of $200,000 to, there's a school that had encountered a leak, and both City Water and us noticed some variations in their water usage. It was really extremely high, was going on for, they spent probably at least a year just trying to figure out where that leak was located. They called in finally a company that had to actually dig up a bunch of pavement in various areas around the school to find that leak. And it was approximately a $200,000 adjustment that we made for that account. So again, you had 2 accounts, which were more than half of that leak. Yeah, so basically there were misreads involving the meters. So the usage that was reported was incorrect for about a 4-month time period, and it was significantly incorrect. I think the CCFs for us were about $65,000, or I'm sorry, 65,000 CCFs, and we bill at approximately $6 per CCF. So we had to go back and make that adjustment.
Was that in multiple locations? Or?
No, it was one location. It was one location, but I think there were a couple of meters there.
Wow, okay.
So again, we had those water agency adjustments that I just discussed. Also, our Department of Environmental Compliance, DEC, does reduction factor adjustments to make sure that what we're charging for is actually for water that's entering into our system. There were 28 of those adjustments during the quarter that resulted in adjustments of approximately $35,000. Moving down to the write-off section, there were 2 adjustments that we made as a result of sheriff sales, which totaled $18,000. We had 4 adjustments relating to properties acquired by LRA, which totaled approximately $61,500. We had a couple of settlements that the ARC Adjustment Committee approved. One was a $214,000 adjustment, and actually that related to the issue that we had with the school. Finally, the last section of the report shows the other billings. These are actually billings that we make. There were 3 billings that we issued to the Bridgeton landfill for treatment expenses, which totaled $30,000. And there were 2 adjustments or billings that we issued to Missouri American Water. One relates to their costs associated with the Lower Merrimack treatment plant. And also, they have a notes receivable for us, which relates to work that was done at the Lower Merrimack treatment plant. Those transactions totaled $636,000. Are there any questions that I can answer regarding the ARC report?
The totals, the adjustment totals, 1.3 million and 1 point almost 8 for year-to-date. How do those compare to typical?
I would say that the water agency adjustments for this quarter were higher than normal because of those 2 transactions that I mentioned. So that was a little more than what we would see. Other than that, the other items are pretty much in line with what we would expect.
All right, thank you.
Sure. Any other questions? Okay, if not, we will move on to the next item that I have, which is a review of our key financial indicators report as of December of 2025. I'll start with the graph in the top right-hand corner. That graph reflects that for our wastewater charges, we're projecting that those will be $3.7 million favorable through the end of the fiscal year. With respect to our stormwater billings that we just started this fiscal year, we're projecting that, it's not the first fiscal year, but for this particular fiscal year, the stormwater billings are projected to be $1.9 million unfavorable. For commercial accounts, we are showing that those accounts are going to be approximately $3.3 million favorable. And for our residential accounts, we're right on target. We're projecting $387 million. Our budget is roughly the same amount. So what's driving our overage is really our wastewater accounts. With respect to the stormwater accounts, we are still in the process of making adjustments. Again, this is a relatively new fee that we just started billing in February of last year. We did a flyover, which is going to result in some updates that we're making, actually, that we just made this past weekend. Not really any significant changes. We had some accounts where we saw increases, some which fell out because obviously the impervious surface area changes as there's construction that occurs throughout the time period. And we typically do those flyovers about every 2 years. So you would expect that every 2 years we're going to see changes to what we bill in terms of impervious fees.
Do you physically do flyovers? Like
Yeah, we partner with some agencies here. They do a flyover of the entire county in our service area. We contribute to the cost of that and use that data to update our billing records.
Huh, okay.
And we'll move on to the next section, the top left-hand corner of the report. That depicts our budget status forecast. So right now, our budget variance is projected to be $41.7 million favorable. Most of that involves our capital program. We're forecasting that our expenditures will be approximately $26.7 million less than what we budgeted for. Our operating expenses are projected to be $10.6 million favorable when compared to budget. And our debt service is projected to be $4.4 million favorable when compared to budget. So good news there on the expenditure side. Moving down to our debt coverage ratio forecast. Our forecasts are exceeding our targets. That's set by internal targets and also targets recommended by our financial advisors. We're also exceeding our rate proposal projections. And you'll see that forecast is higher for our senior debt, And that's primarily because we really haven't issued any senior bonds for the last, couple of years, Tim? And we're borrowing quite a bit through the SRF program, which is subordinated debt. So that's impacted our projections. And then finally, with respect to our average collection period, that really has held steady at approximately 60 days. As I've mentioned before, we would expect that collection period to dwindle down once we're able to initiate account shut-off. Are there any questions that I can address regarding this report? If not, that's all I have. Thank you for your attention.
Yeah, actually, this is probably more for Timmy. Our debt service ratio coverage is still, it is really high.
It is very
which
high.
is what we thought was going to be the case with the rate increases.
It is higher than what we expected because we've done more SRF debt, which is lower cost.
Right.
And also because we've done so much SRF. We had originally, when we did the rate proposal, expected to pay for the fluidized bed incinerators. With $260 million of SRS, $300 million of senior bonds, and a $330 million WIFIA loan, which we had
Right.
already closed on. When the state came back and said, we'll fund the entire amount,
Freed up that senior debt.
yeah, that got rid of the senior debt and the WIFIA, replaced it. And the WIFIA was already contracted about 4.4%. The senior debt probably would have had a true interest cost of over 4%. The state revolving fund loan was like 1.74. So over the 35-year life of the expected financing, it probably saves $400 million. Some of that is up front here. So we are significantly below budget on debt service, or below the rate proposal forecast on debt service, which is why these ratios are so strong.
When we go back to the rate commission, or when the rate commission, when is that, 2 years?
Yeah, we will actually go back in about a year. So we'll start preparing the rate proposal later this year. We'll go back next year and run the process throughout most of the year, and then new rates would kick in the year after that.
Well, and so it's safe to say we're not always going to have the state revolving fund to not bail us out, but as a great option.
I don't expect to get as much as we've gotten, although we continue to talk to them about some upcoming projects. We're on the intended use plan this year for about 60 or 70 million more dollars. We're applying for future years. When we get to big projects like the tunnels, we'll have to see. But especially, federal government cut subsidies, those are actually hopefully going to be re-implemented, but we will see. But yeah, I think we can't count on the SRF funding as much as it has. But these savings that we've had here will go into the next proposal. So we're not going to change the amount of pay-go debt funding that we're planning. So this extra debt service savings is not going to have to be collected in the next 4 years. So that should significantly,
Lower.
should reduce the amount of any increase that we propose. Yes, that's correct.
Okay. That's where I was trying to get to.
Yes, sorry.
Okay. No, that's good. That's how I was. I appreciate all right. So as we go to the rate commission, though, we're going to explain pretty intently why we are where we are.
Yes. You probably remember there was a lot of talk about where, we had projected our coverages, where people thought it should be. So this is something Mary and I have been talking about for a while, making sure that we put together materials that help everybody understand. Because this is it's a good thing that we're, and there will be a benefit, but, there'll always be people saying, see, I told you should have been more aggressive, that sort of thing. But whatever targets we set, we work then actively to try to improve. So I'm glad it was this strong, but I do expect there'll be some pushback. Oh,
That's all I have.
Okay, sorry.
Yeah, no, thank you.
All right, one more item, that's the portfolio update. Just a couple of things I want to highlight here. So I'll start in the upper left. The par amount of our investment portfolio as of near the end of January was $671 million. That is a $33 million increase from December, big increase. That is really driven by the timing of tax receipts. So we're getting all those property tax receipts in now, and this is the first year that we're collecting on the stormwater, the new stormwater taxes. So because of that, we're going to see some higher cash balances because that money's not going to get spent right away. There are, remember that money is being collected so we can do stormwater capital projects. Those are being designed as we speak, and those will start to, be constructed here. Okay, starting in the summer, but we're going to have some extra balances for a little bit. The other statistics up there, yield to maturity. Fed has been cutting interest rates throughout a lot of last year, although they held here just recently. But as we do new investments, they're a little bit lower than where we've been. So we're down about 5 basis points. So but we're still at 4% and above where the benchmark is. That 2-year Treasury's in that 360 range, and that's where the benchmark is. So we're still ahead of the benchmark. Weighted average maturity came down. At the end of the month, we had some trouble putting out some investments longer term because there just wasn't the inventory to pick from. So we're a little shorter here than we usually are at 3/4 of a year average maturity. Well, the benchmark's close to 2 years because it is a 1 to 3 year benchmark. Over the sector allocation, just tiny changes between last month, about 1.5% down on the Treasury bonds and 1.5% higher on the commercial paper. But overall, we are within our policy limits, so complying with policy. Maturity distribution at the bottom right just shows how we compare to the benchmark. And again, we've got a lot more money in the short term, 0 to 1 year, because of that. A lot of our money is going to be spent on projects. And then the fund summary I want to talk about just a little bit because there will be a change going forward. So not big changes on the construction fund. That's usually been around $16-17 million a year. That debt service reserve fund is 0 for the first time since 2004. And I expect it to remain 0. So every time we issue new debt, I do not expect we will have to create a debt service reserve, which is where you just take a portion of the proceeds and set it aside for future benefit. It's supposed to be of the investors, but because of our cash position, because of our strong ratings, that's not something the market requires of us anymore. So those debt reserves were used on the refunding we did last month. So I am going to remove that line. And then what I'm going to try to do going forward is give you a little bit better idea of how this money is allocated, because this allocation really doesn't tell you a whole lot. We've got the construction escrow. Those are funds that developers have deposited with us for some work, and then everything else is just thrown into MSD operations. I don't have good visibility real time in exactly where that money is, but we can make some pretty good guesses just from, because we do monthly financial statements. I just won't have the January financial statements for another couple of weeks, but roughly 10% of this fund is in the general fund, so it's used for general operating purposes. We've got a little over probably 20% now, roughly low 20% is in the stormwater fund. So that's going to be used for capital work, some operation and maintenance. The bulk of it, say 60% roughly, is in the wastewater construction fund. And we've got a big $400 to $500 million capital plan. So that's where the bulk of those funds are. It will be spent on wastewater capital. Probably less than 10% of this is for debt service funds. So we have big debt service payment coming up on May 1st. And so this balance will build as we get there, and then we'll see a good reduction. We do have, we pay SRF interest January and July. Interest and principal are those scheduled dates. That's still lower right now than the senior bonds. And then in November, we do senior bond interest. So you'll see that the debt service piece kind of grows as we approach those dates and then drops after payment. But right now, we're building toward the May 1st payment. which will be, over $60 million. And then there's, less than 5% of these funds are what we call permanent funds. Those are kind of emergency funds or water backup funds, funds that we hold back to make sure that we can pay when there's, weather issues or other issues. So I'm going to put something in here that just kind of goes along those lines. I won't talk about it a lot, but that way it'll be there and you'll have a better understanding, I think, of how this money is being used. Because $670 million is a lot of dollars, but it is spoken for. So, and we do have uses for it.
Why do we have such a large amount of cash in the construction funds? Other than, don't we do like a draw schedule and?
We do a draw schedule, but we have to have the cash. So right now we're targeting a 60% debt funding of the capital plan and 40% cash funding. So some of that is for the cash funding of the plan. And then with the draw schedule, we actually have to pay cash before we can draw on the loans.
Oh, so we front it?
We front the money, yeah.
I got it.
So
Okay.
so right now, the fluidized bed incinerator is the largest project that we've got that we're drawing from. There are a few others going on that are much smaller, but right now we're probably drawing, $20 to $30 million from the SRF funds every year. Just the FBI project alone is supposed to increase to $40 and $50 million a month coming up soon. And then we're also required, whether it be debt or cash, to have money available before we appropriate. So we usually have more cash than we would use right now, just because we have to have funding available when we appropriate. And then usually it's not uncommon for projects to lag a little bit too. So, that's why we break up appropriations on these funds. So we don't have to have all the funds for the $900 million project sitting there right this second. But we just we're going to approve a $270 million appropriation. Well, it's up to you, but there is a $270 million appropriation that was introduced last month that'll be on next week's agenda. And we couldn't, for example, appropriate that much money unless there was funding available for it. Any other questions on the operating portfolio? All right, sorry, we went significantly over, so sorry about that.
My fault.
Okay, next meeting date is tentatively set for March 3rd. Can I get a motion to adjourn?
Okay, Trustee Nicholasison, we will get things set up for stakeholders and let you know when we're ready.
Okay, good morning, everyone. Welcome to the Stakeholder Relations Committee meeting. Can I get a roll call by the chair?
Yes, the record will reflect that all trustees are present, with trustees Nicholasison and Watson online.
Thank you. Comments, there are no comments by the chair. Can I get approval of committee meeting minutes, December 30th, 2025?
Oh, shit. Second.
Thank you. First on the agenda is a discussion by Todd Oshbacher regarding a resolution for legal consulting services pertaining to stormwater and wastewater rate issues.
Thank you. Good morning, trustees. I'm here to talk about resolution number 4,000 that will be on the February board agenda. In this resolution, we're asking the board to authorize the district to renew its contract with a law firm known as Shands, Elbert, Johnalakis, and Gilgum, LLP. Now, this contract with Shands Elbert, it's for specialized legal consulting services in the areas of our stormwater and wastewater rates. The firm has considerable expertise and experience with our rate issues. They have been representing the district with regard to rate matters for many years. It's a sole source contract. It was approved last year, and the contract has 3 one-year renewal options, all at the district's option. And in this resolution, we're asking the board to authorize the first of the 3 extensions. It's an hourly rate, and the hourly rate is competitive with the specialized services in the range of $400 an hour. Any other questions? Thank you very much.
Thank you, Todd. Next is a discussion by Tracy Coleman regarding an ordinance for the district's classification plan. Tracy?
Good morning, trustees. I would like to introduce and adopt the ordinance 16768 for the classification plan. This particular ordinance is going to make a change by adding a new job title for the finance department for the position of accounting supervisor. If approved, this will go into effect immediately. Are there any questions from the trustees? All right, thank you for your time.
Thank you, Tracy. Next, I need a motion and a second to go into closed session to discuss personal actions under section 610.021.3 RSMO.
So moved?
Second.
All right, we'll do a roll call vote. Trustee Kistner.
Aye.
Trustee Wabi.
Aye.
Trustee Watson.
Yes.
Trustee Evans.
Yes.
Trustee Nicholasison.
Yes.
Trustee Wilson.
Yes.
All right, we're in closed session. Thank you.
Position, we're ready to come out of closed session.
Okay, can I get a motion and a second to come out of closed session?
So moved?
Second?
All righty, we are out of closed session. Next meeting date is Tuesday, March 3rd, 2026. Motion for adjournment?
So moved.
Second?
All righty, thank you, everyone. Have a great rest of your day.
Yeah, thank you.